Let's look at this picture and think in this picture what examples we have of what's costs and what's expenses. If you take the point of view of the owner of this retail leather goods shop, what we look at here, the cost of buying the leather goods that are available for sale is cost of goods sold. The jacket that we see here cost the store $50 and it sells for $150. That means the gross margin is $100 of $150 sales, so that's a 66% gross margin. The expense for renting the location, for the counter person, retail sales clerk, for the electric power that power the lights, those are expenses for this business. The costs are the goods it's going to sell. Now, if you take this picture from the point of view of the manufacturer of leather jackets, their cost is a different element. The cost, if you're a leather manufacturer, a leather goods manufacturer, your cost of goods sold isn't the finished jacket, it's the materials that you buy, literally the leather, and it's the assembly and labor costs to cut the leather up and sew it together and so on to make these leather goods. So your sale is the $50 that we mentioned, that the store buys it from you for $50, and your cost of goods sold for the leather coat, if you sell it for $50, it probably costs you $30 in materials and labor. As the manufacturer of the leather goods, your expenses are probably overhead for the factory rent, all of your expenses related to marketing. But we'll get to expenses later. Notice the distinction between costs and expenses here. A fine point that comes up in some businesses, the labor cost is, in this case, the accountant or the attorney. If what you're selling is accounting hours or legal hours, then this woman who is a professional might be your direct cost of sales. So her hour is billed to clients at $200 and the firm pays her, let's say, $100. Her salary in that case might be entirely cost of sales. That's unusual. Normally salaries are expenses, but we do have unusual cases and it's worth going over them. As with sales, timing of costs is critical. We have the 200 units of service that we saw earlier that created, $13,800 of sales in this picture. Well, the cost for this service needs to be matched to the sales of the service. So it doesn't matter when we paid the $6,000 in direct cost of the service, which is probably a matter of parts and paying our employees who provide the service, fix the things. This looks like a computer store. You have to match the cost with the sale, so it's the cost of what was sold that month, regardless of when that cost was paid. So we go on. Expenses. We've already hinted at the difference between costs and expenses, but essentially expenses are like money flying away. Expense is something that you pay. It's not cost of sales. It's part of your overhead, your running rates, your running expenses, your burn rate. For example, rent is almost always an expense. Not owning the building, but renting the business locations is almost always expense. Advertising, travel, utilities like phones and power, people, payroll, are usually expenses. We mentioned a special case, but usually these are your expenses. As with sales and costs, timing is important. You want the expenses to match the month when they're incurred, not necessarily the month when they're paid. So if I advertise in the February magazine, theoretically, the expense ought to show up as a February expense, even if I pay for it in April or I commit to it in January. With some of these timing issues, consistency is important. If you always want to write the expense into your projected income when you commit to it, that's okay if you always do it. If you always do it when you pay for it, That's cash versus accrual accounting, probably not as recommended, because then there's nothing on your books about what you owe until the day you pay it. So timing matters, and we'll get into why later on as we get into standard financial statements.